You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
All right, Maggot. It's time for the Options Boot Camp 301st episode spectacular. So drop the Cheetos, get out of your seat, and put your hands together for the drill instructors who've been whipping you into options trading shape since 2012, Mark Longo, aka the voice of options and the black-hatted one himself, Dan Passarelli, the third Esquire. What better way to celebrate 301 glorious episodes than by taking on all comers in an all-out Q&A palooza? So enjoy, and you're welcome, maggots.
Oh my God.
That was a fun one. You like that? You like that, Mr. Dan being elevated to not just the third, but Esquire, sir?
Yeah, that's pretty funny, man. That is definitely pretty funny.
All right, listeners, a little bit of a fun special intro because, as you might have guessed by that little bit of fun, this is a very special episode of Blossom. We're not just going the usual route here because it is, of course, the epic to follow along with The Simpsons 301st episode spectacular. Because, of course, as is the way with this show, last week, Dan, I'm not sure if you were aware, was episode 300. And neither of us was around for it. We recorded it ahead of time. Well, you were doing your mastermind. I was traveling. So, of course, we missed the opportunity to go big, go live on it. But the plan was to do it live from your mastermind. Unfortunately, other events intervened. But you know what, listeners? We are here now. What better time to get into it than with a little bit of the 301st episode spectacular? Yes, been holding court on this fine show since way back in the dark days of 2012. Obviously, the network goes back to January of 2007. This show since, I think it was August, September of 2012, sometime in that time frame. Of course, I know for a lot of listeners to this show, 5, 8, maybe a decade before, years before you started trading options out there. So we know there's a lot of newcomers to the show. We love you all. Welcome all to the show. But time to have a little fun. My name, of course, as the man said, Mark Longo from theoptionsinsider.com, a.k.a. the voice of options, and my compatriot here, the black-hatted one himself. Also, your favorite options lawyer, Dan Passarelli III. Mr. P, welcome back to the show for our 301st episode spectacular, sir.
Oh, man, I can't believe it's been 301 episodes. That's crazy, man. That is crazy.
It seems like forever ago when you and I first met on that panel out in Las Vegas at that, I think it was a money show. That shows how long, because I haven't been to a money show since, so that's probably the last time. I think you and I both got roped out. I think we did the Futures Mag panel together, as I do recall. And I was like, who the hell is this Passarelli idiot? He won't shut up. And then after the panel, listen, he kept pestering me. He's like, hey, I heard that network he got is pretty cool. We should do a show on it. And I finally, just to shut him up, I said yes. And a decade later, I can't shut him up, listeners. He will keep coming on the show. The black-hatted one himself, Mr. P from Market Taker Mentoring. Nice to see that our listeners are having fun as well. This week's 5-star review looks like it's from one of our international listeners. His name is Callum. Sounds like an international name. I'm guessing across the pond. Oh, he says greetings from across the pond. So I was correct. I should have read one line ahead. Greetings from across the pond. Thanks for this awesome show. So Dan, you've met some of our listeners from literally across the pond. You went to Oktoberfest with them not too long ago. So great to see that 301 episodes in, the love is still coming, even from across the pond, sir.
Yeah. That is true. I'm going to Oktoberfest. Oh man, that was crazy. That was crazy, man.
Are you going back this year? Any plans?
No, not this year. Not this year.
You had enough beer for a lifetime last year. I understand.
I recommend it though.
I understand. I also recommend a little bit of a 301st episode spectacular, listeners. Like the man said, what better way to do that than by taking on all comers with your questions? It's a 301st special edition of the Mail Call.
Mail Call. Time to look at questions submitted by our listeners.
All right, listeners, I know you're champing at the bit to get at the 301st market taker question of the week. Before we get there, we can't just give you the steak right out of the gate. You got to make you wait a little bit for it. Let's get to some of the questions you folks have been weighing in on pretty intently of late. Let's start with these ones from last week while we were on hiatus. The show was still on, of course, for you folks on demand. But Dan and I were elsewhere last week, and we had a couple of fun ones. First off, Dan, I believe our good buddy on the Option Block show, the Flowmaster, I believe also the guy who constructed a lot of your trading scanners. Is that correct, sir?
Oh, yes, that's right.
Mr. Schwartz from Trade Alert. He was on our Option Block. He's on with us every Thursday. And he said he thinks we'll be above 20 in VIX for the rest of the year. I thought that was an intriguing statement, especially coming from him, a guy who doesn't just shoot off at the hip like one Mr. P, the gunslinger here. He actually crunches his numbers. And so I thought that was kind of interesting. So I thought put that out to our audience. I don't know if I agreed with that, but I wanted to put it out to the ultimate arbiters, Dan. Our audience. First off, Dan, what are your thoughts on that? Do you agree or disagree with Henry? He thinks he'll be above. Obviously, we know the answer now is no. But outside of this week, maybe, do you agree with that sentiment? And then B, what do you think our audience said?
Well, I will qualify your off-the-cuff comments on me not crunching numbers because I'm a number cruncher. So I just want to throw that out there.
You're the black-hatted one. You're a gunslinger. We know this. That's why we like you. I think that, I don't, well, first of all, we're not over 20 right now. But I wouldn't be surprised if on average we're, at least 18 between now and the end of the year. I think there's definitely more volatility coming. I can't say I didn't think the other way. In fact, I put my money where my mouth is. I loaded up on some SVIX calls last week, and they're looking pretty good right now. SVIX is roaring back to life, listeners. So we talked about that before in our vol products episode, I believe, from last year. SVIX, of course, the inverse vol product, and has roared from about a 19 to about a 30 right now, up $1.30 today, or 4.5%. So as VIX obviously continues to come in, SVIX continues to climb, listeners. So I didn't really agree. Surprisingly, Dan, our audience did. 55% said they agreed with them. 45% said no. Of course, we all know right now the answer is no, because we are back in, I believe, as we kicked off the show at, 1660 in VIX cash out there. We also did a flash poll last week, Dan. It was a quick one, but it got a lot of people very excited, as you might imagine. We said there was a lot of talk last week and all the turmoil. Of course, we go away for a week, Dan, and the entire market decides to melt down around us. So I guess that just proves we need to be live every week. Otherwise, it all goes to hell in a handbasket. But we asked last week. A lot of people were beating the drum. Okay, market's melting down. We need an emergency rate cut. Time for the Fed to step in. And we asked our audience, and I'll ask you, Dan. First off, the answer is here, so you can look if you want, but it was a flash poll. But where do you fall on that? And B, which way do you think our audience fell?
My answer is no. And I think our audience also says no.
I concur with that. I said no. Our audience, good to see, because people were beating that drum pretty. Even I saw stock twits, I think, yesterday saying, Jay Powell, you're our only hope. It's an emergency rate cut week. It's like, really? Are we that big of a market? We have a couple of days of red and we all lose our minds. No, come on. The market needed to sell off. You could argue it probably needs to sell off more. But that said, I don't think we need Powell to step in. And our audience agrees overwhelmingly, Dan. 70% said. And I love that we have cooler, saner heads in our audience. They're not out there just saying, hey, you got to make this market rally, Powell. So I expect that from the CNBC cheerleaders of the world. Maybe not so much from stock twits. They disappointed me there, but intriguing stuff nonetheless. All right, let's get out to a question of the week from this week, which is live right now. You can get at us at Options listeners. We said just, I think it was Monday or Tuesday, MIAX launched a new options exchange, Sapphire, that brings the total number of options exchanges in the U.S. listeners to a whopping 21. Yes, 21. So we thought it was a good time to ask you folks, quite simply, is that too many? Not enough? Is it Goldilocks just right? Or do you just not care? Dan, where do you fall on that? Too many, not enough, just right, or do you not care? And then more importantly, which way do you think our audience is going right now?
I believe that it's 20 too many. The whole point of...
You want one. You want to go back to the one exchange to rule them all.
Yeah. I mean, the whole point to an exchange is transparency and to have one single place where everybody can have fair and equitable, information. And when you have it this disparate and disjointed so that people can have orders that allow them to front run and all that, it's the SEC just does not understand. I don't know, price discovery, what is actually happening in the option pricing world, the deal making. Like it's absurd.
Yeah, you could argue 21 is absurd out there. And you can also argue that maybe for a lot of our audience, many of them listening to this show who are newer, they just want to get filled on their 10 lots. They don't care where it happens. And that's where the lion's share of our audience is coming down right now, Dan. 55% say they don't care. They just want to get filled. 30% maybe agree with you and myself that it is quite a bit too many. I don't know if I'd go with one, but, sub 5, I think, is probably the right answer. And then 10% saying 21 is just right. That's the Goldilocks number, Dan. 10% of our audience, they were waiting till we got to 21. Now it's perfect for them. That's exactly what they needed. That cracks me up. I thought we'd get 0 for that. And then 5%, Dan, say 21 is clearly not enough. All the exchange reps in our audience raising their hands right now. That's who that is. 5% saying they want more than 21. So yeah, listeners, we got quite the whirlwind of exchanges out there. And it's always a whirlwind when Dan takes us on a ride for the Market Taker question of the week.
And now, it's the moment you've been waiting for. It's time for the Market Taker Question of the Week.
All right, wouldn't be a 301st episode spectacular without a question of the week. Dan, do you remember in the primordial ooze days of the show, the Market Taker Question of the Week was just a gleam in our eyes, hadn't really come to fruition yet as a regular segment. Sure as hell didn't have a cool kick-ass theme song, Dan. So 301st episodes, you got to bring it. What do you got for the people, sir?
All right. So this is a question that I asked myself earlier today. When is it appropriate to use the stock repair strategy? And let's talk about that for a minute. There's a stock that I own and that I recently sold some more puts on. Arch, ARCH, which is Arch Resources, that is involved in metallurgical coal and thermal coal. And they are at a low. What is it? Is it a 3-year low? Let me just take a look at the 3-year chart. No, not a 3-year low. They're at about a 1-year low right now. Pretty decidedly at some pretty strong support right now, coming up on the 200-day moving average, about $1.50 away from that. And that's always a strong support level. And there hasn't really been that much news. Their last earnings, they beat, as I recall, but they had lower earnings than they did year over year. And I'm looking at this is a stock that I've owned and followed for a long, long time. And I'm like, this downward move just doesn't make sense. And if there's ever been a time to sell more puts, I'd consider doing that. But, I'm looking to take assignment on the puts this Friday. And I know I'm taking the long route here, but so yeah, this would be an excellent one for the stock repair strategy, especially if you owned it at a higher price, like maybe 160 or something like that, even 150. Whenever you see a pretty good move, at least 20%, probably not more than 40% lower, and you're looking for it over the next few months to retrace, at least partially, it can make for a really super excellent stock repair strategy trade. And for those of you who are not familiar with what that is, you buy an at the money. If you own 100 shares, you buy an at the money call, and then you sell 2 calls halfway between where you own it and where the stock is now. Where you originally bought it and where the stock is now. And the idea is that if it retraces just halfway because you bought that extra call, you get all of your money back. The reason why you do 1 by 2 is because you try and sell 2 calls at the same price that you paid for that 1 call, so the whole thing just doesn't cost you anything.
Interesting. Dan P. Esquire coming out with a little bit of stock repair love. We have talked about this a number of times in the past, including most recently some of our ratio trades. I remember in the past, I think you were kind of lukewarm on this just because it has to work out perfectly, right? You got to get it right in that sweet spot, and you've said in the past that's kind of a low probability thing, but sounds like you're warming up a little bit to stock repair, sir.
Yeah, and I do remember saying that in the past, but I've kind of looked at it a little bit differently now. I don't know how perfectly it needs to work out. I think that even if it doesn't work out perfectly, it still works out pretty good, and you can do some adjusting. So I think I've learned a little bit more about it recently just by, you think about things for 30 years and you start getting better at them. Go figure.
See, listeners, it's not just you. We're all learning out here. And it does seem like stock repair is a divisive thing. So people have come on here and been like, oh, it's a magic trick. People use it for presentations because it looks cool, but it never works out that way. But yeah, I'm with you. It can work out. Maybe you don't have to get all the way there to make things better than just owning the stock and praying, right? So, yeah, there's intriguing stuff to be had. And Dan, as you'll recall, when we kicked off this show way back in the primordial ooze of 2012, we had a strong military theme to the show. I was coming on here with my drill instructor voice. You recall those days, Dan?
Yes, I do.
I quickly ran up. It just killed my voice. It was like chewing gravel. So I kind of dialed that back after the first 3 episodes. But you know what, Dan? Our listeners remember, just like this week, Just Jeff Morey. Just Jeff wrote in. He says, "Hey Sarge." So he's down. He's down with the theme. I like it, Jeff. Bringing it here on the 301st episode spectacular. And his question is not that dissimilar from what you were just talking about, Dan. You were talking about stock repair. He's talking about the old poor man's covered call, which is diagonal with some other moving parts, but an intriguing nonetheless. Not quite a ratio, but an intriguing one. He says, "Hey, Sarge, I wanted to get your thoughts on the, quote, poor man's covered call that I've been seeing on my feed lately. If I understand it correctly, it's when you buy a deep in-the-money leap on a security and use that as collateral to sell calls against it." Yeah, that's the basic structure. It's called many things. I know Brian Overby is a big fan of it. If you want to go deep into the quote-unquote poor man's covered call, he calls it the fig leaf because you're kind of covered. We've called it the synthetic covered call on the show. It's got many different names here. If you want to go deep into the fig leaf and see a lot of examples of how to use them, check out the Options Playbook radio feed here. Sarge is us, I would say. Jeff, just Jeff. Because he goes deep into all things fig leaf / synthetic covered call. But your basic premise is correct. You're going to go out in time, usually at least 6 months, and going to buy a meteor, usually going to be in the money. Probably somewhere around 60, 70 delta, I would say at least. Some people like to go higher, Depends on you and what kind of outlay you're comfortable with, but somewhere in that ballpark. And then you're right, you're going to sell nearer dated calls against it. Could be weeklies, could be monthlies, whatever floats your boat. If you're really hardcore, you want to pick up literal pennies, and you can go 0 day, I suppose, depending what you're trading. His question goes on. He says, it seems to make sense, but apart from the risk of the leap going out of the money and getting assigned on the short, which would be a disaster, what other things are there to consider? So, of course, listeners, the leap going out of the money means the stock falls. That's kind of the worst case scenario with this one, really, where you're buying a deep in the money leap and stock falls against you. You're going to lose money on that trade. Getting assigned on the short, that may or may not be a disaster. It's not the best thing, but it depends on how it works out. We'll get to that in a second. He says, what other things are there to consider? I have a small account and want to grow it by going net short to the dark side. Okay, knows what he wants. But going cash secured or 100 shares collateral would tie up too much capital. What are your suggestions? Thanks, Jeff. Well, Jeff, picked a great time to write in here on the 301st episode spectacular. Dan, a lot to unpack here. I have my thoughts, but I'll let you have first swing at it because I'm that kind of a nice guy, and you are the world's first options lawyer, after all, so you speak from a voice of authority. A couple of things to unpack here. First off, he says he has a small account. He wants to sell premium, but he can't do cash secured puts, or he can't even do, as he says, full 100 shares collaterals. That would tie up too much capital. But then his next idea is the stock replacement strategy, which is obviously less capital than buying the stock, but still not exactly low capital. You still got to buy a meaty contract there. So I'm curious, what are your thoughts on what he lays down and maybe your suggestions for Mr. Just Jeff?
Well, Mr. Just Jeff, don't paint yourself into too small of a box, man. Like, if you have a small account and you can't buy shares of stock, then that's fine. But there's a lot of different option strategies out there that don't really require very much capital. You don't have to stick with this, covered call or some cheaper variation of a covered call. Frankly, there's a lot better, higher reward and even higher probability strategies out there. So all you really need to do is get good at like 2 of them. And in order to get good at 2 of them, get good at 1 of them first. I just think it's good to not be a one-trick pony, have a couple tools in your toolbox. So, I mean, that's what I would say from an overarching general standpoint. Like, look into debit spreads or credit spreads or time. I mean, especially time spreads. You can get massive edge with time spreads if you get good at them. But then to narrow in on your specific couple of questions here, and it's kind of interesting because it looks like basically 2 completely separate and actually opposite questions. Poor man's covered call being a bullish strategy typically, but also wanting to go short shares, I think, to short the market. So
I'm assuming he means short premium. That's what I'm thinking.
Oh, I see. Okay. Oh, I got you. Right. Yeah. So, man, like, just look into spreads. Like, if premium selling is something that interests you, or maybe you've done it before and you have somewhat of a knack for it already, focus on that. Look at credit spreads and stuff like that. The poor man's covered call, that's just going to give you that bullish bias in a market where, look, if in the long run, the market goes up 8 to 10% a year, but not every year. And this market is maybe a little more precarious than a typical market, I would say. So, spread your wings a little bit and maybe consider other strategies as well.
Yeah, I would definitely encourage you to consider other strategies, Just Jeff. We'll start with your first question. You mentioned kind of the poor man's covered call. You're right on those are the kind of worst case scenarios. But getting the underlying called away, getting assigned on it, it can be scary because you don't have the collateral. So then you have a couple of decisions to make, obviously, because you're not really covered, hence the poor man's or synthetic covered call or the fig leaf. You have to either buy the stock, roll the call, or exercise your deep in the money call, which is never ideal because remember, whenever you exercise that, you're losing all of that time premium that you paid on that option. So you consider that really the risk of your poor man's covered call here. It's the time premium you paid for that longer term call, because if the worst comes to pass and something happens and you need to exercise that call, that's going to go the way of the dodo. So if you do things right, kind of your max risk in that scenario. And of course, the net outlay for the call as well, because obviously the underlying, the stock can go to zero. But I don't think this is the right strategy for you, as Dan was saying. You have limited collateral or limited capital, and you also say you want to sell a lot of premium. So I think, yeah, Dan mentioned debit spreads, but you want to sell premiums. I would say credit spreads, definitely. They're risk mitigated. It's not going to tie up anywhere as much collateral as if you just said, hey, I want to sell a put cash secured. That's going to tie up a lot of collateral now. But instead, you sell a put spread now. Now you just have to worry about that spread width. And that's really all you have to focus on. So that's much more viable for you, I would think, in a small account. And again, take small nibbles. Take your time. You start off with maybe some small put spreads. You've identified a level in a stock that you don't mind selling a put at, but you're also going to buy another put below it just because you can't afford to buy the stock and you don't want to tie up all of that margin. That makes a perfect amount of sense. You know exactly when you get into it how much you're going to collect and how much you can lose. It's a very risk mitigated strategy. Then you could advance to other things, spreads with wings. I was talking to someone yesterday who had a system for 0-day and 1-day iron condor selling. Yeah, it's a little bit more advanced, but you could do a lot of different things within that credit spread umbrella. And then if you advance, as Dan was saying, you can get into things like calendars. That's more of a 201 or 301. I would very much say start off selling things like put spreads and get a feel for those and how they work. And then I would stay away from anything that utilizes the underlying, or even in the case of the poor man's covered call, a cheaper version of the underlying, because it's still capital intensive. I mean, if you have a small account, that strategy is not viable for you. Start nibbling with some short put spreads, maybe some short call verticals if that's your thing, whatever floats your boat, and then start graduating to other spreads. And then let us know. Let us know what you choose, Just Jeff. But I would definitely say, given your limitations here, stay away from the poor man's covered call, aka the stock substitution strategy, because it's not going to be viable for a small account. All right, let's go out to, I like this handle, Big G. Big G writing in says, love the episode about hedging weekend risk. I'm still a work in progress on that front. Well, as Dan mentioned, we're all still learning, Big G. We're all still works in progress. He says, any more info I can look forward to on that subject? Yes, good timing, Big G, because our buddy Mr. Matt from Orats, who's been on this show a few times as a guest, he's famous out there for back testing and crunching all the data on all of these trades and strategies. He and I just had a long talk on the most recent episode of The Advisor's Option about this exact topic, weekend risk and hedging it, and his ways he thinks is the most effective to do it. Buying put spreads or buying puts in SPY, buying calls in VIX, whether he likes those, doesn't like those. He actually has a unique way to go at weekend risk. He talked about that UVIX strategy that Russell has been talking about. So we go deeper into that. So that's another reason, listeners, why I say if you're listening to Options Bootcamp alone, you're missing out on a ton. Make sure you're getting the full network, and then just go back about a week, maybe two, and you can find the Advisor's Option right there. It's the most recent one, and you'll hear Matt and I talking at length about a variety of ways to tackle weekend risk and some data behind it, including his intriguing way to do it, which is not something we talked about that often on this program. Dan, anything else you want to add on the subject of hedging your weekend risk, sir?
Yeah, I started thinking about that UVIX strategy that you talked about, Russell talking about. And it's funny. I think you told me about it, 3 weeks ago or 3 or 4 weeks ago. And like that next Friday, I traded it.
You did. You did it. You had the best weekend in history on it then.
No. I did it the weekend before.
Yeah. Joined the club. I missed it last week, 2 weeks ago.
Yeah. and then like the next Friday, I don't know, I was just crazy busy and like I didn't do it. And that would have been the best freaking weekend. Like that's a once every 5-year lucky trade. But oh well.
Yeah, that one annoyed me too. I was traveling that week, so I specifically said on our Options Oddity show for our pro members, I think it was on Thursday, I did it early. I said, I'm not going to do the UVIX trade this weekend because I'm traveling. I don't have time to manage it or watch it. And that I would have done 1,000 lots. That would have been at least, 10 grand just for closing to opening print Would have been a nice little do, as they say. And of course, I know Russell scaled his back too because he got burned a few times, so he still had it on, but to much less size. So everyone, even the guy who came up with it, kind of missed it on the best weekend in the history of the product. Then I had a little bit on last weekend and it got run over again. So yeah, it's been an intriguing one out there. I would definitely say tread carefully on that UVIC strategy if you're intrigued by that one. All right, let's go out to Dominic. He's got a question about a product I know you like, Dan. I've been to a few of your masterminds. I've seen this ticker on the wall when you and your crew are analyzing trades. He says, how does the group view BITO as an options trading candidate? It pays a very large dividend, which is certainly worthy of note. Do they like selling puts or even owning the underlying to attempt to capture that massive dividend? I have some thoughts on this. Mr. Dan, what are your thoughts on BITO?
Well, it's something that we talked about before, and I looked at before pretty closely, but I'm out of that currently. So I don't know. I don't really have a great comment on it. I think that you and I talked about it. If I'm not mistaken, you determined that there's not really a lot of contango bleed like some other stuff like VXX and such.
No, it's nowhere near those products. No.
Right. So I don't know. I mean, why don't you just trade Bitcoin? I mean, unless you really want to use the options.
That's the thing, the option side, right? It's hard with the options.
Yeah. So I don't know, man. I'm not a good guy to ask on this, honestly. I have no expertise on it.
I do like BITO. I have traded a few times. I will say last week when I was traveling, one of the few trades I did try to put on in between my various jaunts was putting on an order to try to sell some. BITO was selling off like everything else was early last week. And I had an offer to sell the 16.5 puts. I, of course, missed them. I didn't have a chance to really babysit the order, so because BITO turned around most of the market turned around aggressively. That would have been a good do, as they say, because BITO much higher now. And that would have been a decent level. I've talked to our buddy Mr. Bill on our crypto rundown program as well about getting back into BITO at some of those mid-teens levels, and he was interested in selling puts there as well. So because it's a decent historical level, BITO has tended to bounce off that in the past, and also, as we said, it pays a hefty dividend. So while you're even in the middling months, you can still collect a decent amount of income in this name. So that makes it more attractive than some of these other ones. But again, it pays a hefty dividend, so you have to bear that in mind when you're out here trading this one. But an intriguing one, selling puts to get in. I don't hate that. You could turn around. There is a little bit of juice to the call sometimes, so you could usually get out for something again. But there's a hefty dividend, so bear that in mind. But it's an intriguing one. I don't hate selling puts at that level, somewhere in the mid-teens. And if you get it put to you, hey, you could at least collect a decent dividend. Now, the thing to remember about the dividend is it's not automatic. It's not every month. It's usually when we have a good run in Bitcoin. Then, of course, as a result of closing and opening of new futures positions over there on CME, they have this massive pile of cash they have to distribute to you folks. And it can be substantial. It was over $1 recently. Again, that was because of the massive run-up in Bitcoin. But again, you're looking at any of the numbers you see, 20, 30, 40 odd % a year in terms of dividend yield on this name. So it does make it attractive, especially with the underlying starting to get a little bit more attractive. When it was up threatening 30 again, different story. But yeah, an intriguing one, certainly if you like a little bit of income as well. This is another fun handle. This is Donkey Max. You might get reward for handle of the week here, Donkey Max. He says, I've heard Mark mention on the network recently that calls are, quote, bid in the Russell 2000 right now, and how that's a pretty unprecedented event. What does that mean, and why is it so unprecedented? This was probably a few weeks ago when I was saying this here, Donk. Not really the case right now, but leading into the big sell-off, Russell 2000 was exploding. It was outperforming. It had moved over 10% in about a couple of weeks, which is kind of unprecedented movement for a major index. Now, when I say that, people do forget the entire market cap of the Russell 2000 is somewhere around an apple. It's a few $1 trillion. So bear that in mind. It is more more prone to these outsized movements than, let's say, the S&P or the NASDAQ. But it has had a pretty strong move, and as a result, you have these scenarios that happen in the Russell 2000 that don't really happen in other major equity indexes, which is where the calls are actually at a premium to the at-the-money from a volatility perspective. That's really never going to happen in the S&P or the NASDAQ. But in the Russell 2000, it can when this thing is shooting up like crazy. And it would have been a good trade even to buy them at those inflated levels because the Russell 2000 exploded to the upside. I haven't gone and pulled up the most recent skew data. You can go find that for yourselves, listeners. If you go to cmegroup.com/TWIFO, TWIFO, that is the show we do with CME every week, This Week in Futures Options, and just select equity indexes and go to Russell 2000, it will show you the quote-unquote quick skew. Right now, how is it shaping up right now? How are the calls and how are the puts compared to the at-the-money? So you can go see that data for yourselves completely for free because we like you folks out there. And you can see exactly how bid or perhaps offered. Usually in most equity indexes, the calls are going to be at a discount to the at-the-money. The puts are going to be at a bid. So seeing any sort of evolution in that is a somewhat unprecedented event. Dan, what are your thoughts on what we saw out there in small caps leading into the sell-off, the strong bid we saw in the calls, and what are your thoughts on it, sir?
Yeah, I mean, that's interesting. I wonder if that has to do with like a rotation trade sort of scenario. Although the rotation trade has been kind of weird. Like I remember, a couple of years ago talking to Abigail Doolittle and from Bloomberg. And, we were talking, I think I was on Bloomberg talking about this, that growth stocks, which are largely tech stocks, need low interest rates because they borrow money to grow. And so when interest rates started going up, there was a rotation out of growth stocks into cyclical stocks, which are just like regular old stocks. But I heard a different narrative from somebody that I really respect, Joe Weisenthal, was talking about it in just my morning Bloomberg newsletter, and saying that lower interest rates would be good for cyclicals because they have a lot of debt. So I don't know. I'm just kind of puking some thoughts out there. I don't have a good answer for it, but hopefully that's some good stuff to think about. Maybe somebody will get an idea and send it back our way, and we can talk about it next week or something.
All right, Dan, let's get out of here for the 301st episode with a little bit of fun. We like to have some fun on the show here as well. A couple of things on our live poll right now. We have, of course, we were talking, listeners, about how many exchanges is too many. 21, is that too many? Not enough for all that fun. Dan and I both leaned on the too many. One of our pro members just chimed in, Age Del Aquarius, saying 21 is good only for playing blackjack with Don Schlesinger. Far too many exchanges. So yes, he is correct. We gotta get Dan on, or should we get Dan is on this show. We gotta get Don on this show. Hard to get him out of retirement, but he has been on a few times lately on the network over the last few years. Mostly to talk blackjack, ironically. But if you're not familiar, Don Schlesinger, my former co-host on Volatility Views, and the man who is literally in the Blackjack Hall of Fame. He literally wrote the book on card counting. So an intriguing one out there. Let's have a little bit more fun, Dan. I tweeted this out last month, and a lot of people had fun with it. I said, Exhibit A, for anyone who thinks inflation is under control. There's a Greek restaurant down the street here from the studio. I said they are now charging $52 for gyros. And so I included a screenshot of the menu for people to see. And I said, how many gyros would you have to eat to be worth $52? And a lot of people replied, that's insanity, that's insane. It was kind of fun. People sending in how many gyros they think are worth $52. But it kind of cracked me up, Dan. So people think inflation under control. Maybe they missed that. Also, I had a related tweet to that last week, Dan. I was off getting gas at our local Costco. And as you do, Dan, that's how they get you at Costco, right? Once you get the gas, you stop in to get a couple of things, right? And that's how they get you. You walk out $200 later. And I was walking by the back aisle, and I saw a couple of the guys in line to get those chickens. And you know, sometimes if you've been around the chickens, they can get a little dicey. And I saw two guys literally come to blows over a $4.99 chicken at Costco. So that's what we're living in, Dan. $52 euros and fighting for sub $5 chickens. I present. Is inflation under control to you, Dan? I ask you.
I'm going to have to go with no on that one.
Screw the Fed's numbers. This is real world data I'm giving you, Dan. This is gold. This is gold here. In the meantime, if folks want more real world fun beyond just the 301 super fun episodes of this show, Dan, where should they go? What should they do?
Well, make your way on over to markettaker.com, 2 T's in a row, and you can join our online community. We've got some free classes there for you, and we welcome you into the family with open arms.
Also, make sure to take his options legal course for aspiring options esquires. It's a banger. It's the only one I know of, Dan. So I tip my hat to you on that. Teaching the options law as only you know it, sir. So well done. Dan Passarelli, Esquire. Find him over there at Market Taker. Don't forget the second T for Theta over there at Market Taker. And, of course, you know where to go. They're bringing this episode to you, and they haven't done all 301, but they've done a few recently. It's, of course, our friends over there at public.com, the place to go to kick the tires and light the fires. Kick the tires on that rebate. We're just talking about people fighting for chickens and paying $52 for euros. Maybe you could use a little bit more money in your pocket. In that case, the rebate, not exactly the worst thing. So go kick the tires on that. Let them know we sent you. It goes a long way towards supporting the show for another 301 awesome episodes. Let's see if Dan has another decade in him. We'll see. Public.com, the place to go to kick the tires and light the fires. But you want more options goodness, and you're hanging out in our pro, you don't have to go anywhere. I'll be back in a little bit with our buddy, Mr. Vixologist, a.k.a. Jim Carroll, to tackle all of your crazy vol questions. And given the last couple of weeks on the vol front, I'm sure you have a ton about UVIX and SVIX and VXX and VIX itself and the futures and the term structure, contango, all that crazy stuff. Get him in now. That should be a popular one. He'll be joining me in a little bit at 3 p.m. Central, so get those questions in now. If you want to join that, you also want to join our buddy, I believe it was Wolfpack, who won the July Pro Trading Crate. Only one place to go, theoptionsinsider.com/pro. Then I'm back again tomorrow with our usual doubleheader, listeners. The option block with our buddy, the Flowmaster. And then followed by This Week in Futures Options, where all those reports come from. And then on Friday, we're back again for another doubleheader. First off, noon Central. We'll be diving into the world of vol with all things volatility views. Who will join us as guests? You got to tune in to find out. And then after that, one final time for the pro folks. Options oddities. Are the Rock Lobster and I, are we rolling our calls in Portillo's? What are we doing? What's going on with these SPIX calls I bought? All sorts of fun. Options oddities, the place to go. You get that over there on the pro as well. Then we're back again next week, all the way through to next Education Wednesday and the 302nd episode of Options Bootcamp. Stay safe out there, everybody.
Check out public.com if you want to literally earn money to place options trades. There are no commissions or per contract fees. And Public gives you a rebate of up to 18 cents per contract traded. Discover why NerdWallet recently gave options trading on Public 5 out of 5 stars. And start paying less than $0 to trade options. Only at public.com. Paid for by Public Investing. Options not suitable for all investors and carry significant risk. Full disclosures and podcast description. U.S. members only. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.